Welcome to another episode of the Equity Mates Summer Series. This is a podcast where we explore what is possible in the world of investing. If you've just joined the community for the very first time, a huge welcome. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode and for this series where we are speaking to a selection of great fund managers and financial advisors from across Australia and unpack lessons from their lifetimes of investing and understand how they would start investing today, all to make 2025 our most financially successful year yet.
Yeah, huge.
Yeah.
So today we are pleased to be joined by Peter Nevill, a former Australian Test cricketer, 17 tests for Australia under the belt, and a highly accomplished advisor at Viola Private Wealth.
So we've had a number of professional athletes on the podcast over the journey of Equity Mates. And it is really fascinating to hear how they transition from one, elite profession into another, how they self-educate, how they upskill. And I think Peter in particular is a really interesting story of having that growth mindset, always trying to learn, which we get into and we try and understand. But on the flip side, I found some of the biggest takeaways from this conversation were just how Peter and the team at Viola Private Wealth were positioning their high net wealth portfolios to sort of capitalize on this moment of euphoria, I guess you'd have to call it.
Yes.
Yeah.
Certainly made me look forward to the moment where they can manage some of my money.
Yes. Yeah. Now, a few of the opportunities we speak about are less accessible for people like you and I, water rights and different private equity strategies and asset-backed real estate lending. But I think a lot of the principles that we hear are applicable regardless of who advises you or how much wealth you have in the portfolio.
Absolutely.
Yeah.
Now, we want to say a huge thank you to Viola Private Wealth for supporting this series. Viola Private Wealth specialize in managing and growing assets while helping families pass on their wealth with confidence. Managing over $2.5 billion in assets, their approach goes beyond financial planning. It's about creating a legacy that lasts. With decades of expertise, they guide families through the complex terrain of intergenerational wealth planning, crafting strategies that stand the test of time.
Trusted by members of the Equity Mates community, Viola Private Wealth helps individuals grow and protect their wealth. To learn more, visit violaprivatewealth.com.au. All right, well, Bryce, with that said, let's get to our conversation with Peter Nevill.
Well, Peter, welcome to Equity Mates.
Thank you very much for having me. Pleased to be here. I know I follow in not a long list, but definitely a list of cricketers that have been on the podcast before.
Yes, we've had Cowan. Kawaja. Is that it?
I think Steve Smith
Steve
went
was
on.
on
He
the-
hasn't been on
Crypto.
Equity Mates. He was on Crypto
He was on
Curious.
Crypto Curious, yes.
Talking about his NFT collection.
Yes.
Probably doesn't talk about it as much today.
I do remember, actually, I listened to Ed's episode when he came on, and I remember at that stage you guys had that question, like if you're long or short Australian property. And I do remember Ed saying he was very short Australian property.
Yeah.
And that might have come back to bite him in the backside a little.
Potentially, yes. I don't know. Yes, I think he still is. I know he doesn't own. So I think he's held true.
Yeah.
But,
Put his money where his mouth is.
I think TDM have also done very well over the same period of time.
Indeed they have. Indeed they have. Yeah.
Well, given you've brought it up, question without notice: are you long or short Australian property?
Ooh, that's a very, very big question. In the context of what we've seen, and I can speak to this for a little bit of time, so I don't want to waste too much time. But in the context of what we've seen probably over the last whatever it is, 20 or 30 years, you've gone from, what was, a single income family where, one of the spouses worked and the other one stayed at home. You've seen a massive reduction in interest rates over that period of time. You've also seen, quite incredible population growth. So all of that has, I suppose, accumulated into what we see now in house prices in Australia, especially the sort of Sydney, Melbourne, very constricted geographic area, Sydney especially. And we've seen, essentially property prices being a function of what people are able to pay for them. So now that, it's pretty rare to see people buying property without, both spouses working. Also, we've had sort of interest rates at rock bottom levels. You're still going to see that demand and that population growth, but also it's going to be a function of what people are able to pay for them long term. And if we're in now a structurally higher interest rate environment, the ability to borrow and the ability to purchase property, we might see, I don't know, we might see it stagnate, we might see it continue going up, we might see it come down.
Those are the options.
All three options.
I've got splinters in my bum from sitting on the fence there.
Just now, while we're talking about property, one thing that we're interested in, like you mentioned, we've spoken to some cricketers previously, and it seems like chat in the dressing rooms is mainly about property. Was that your experience as well? Was there much talk about the share market?
No, I think there was a lot of, especially before, the days of NFTs and even, when cryptocurrency wasn't even really spoken about either. There was really, I suppose there were two camps. There certainly were people that were, very bullish property and, seeking to, I suppose, borrow as much as they possibly can and use the equity in the other properties that they already had in order to continue doing so. But there was also a camp that were, very much sort of equities focused and, wanting to invest in, companies able to grow their earnings over a long period of time and, become the leading companies in the world, which, now make up, the vast majority of indexes now. And I firmly sort of stood in that camp. I was never one that, wanted to, I suppose, seek to go down that property path. It was always, very much a function of, being able to put your money to work in productive assets. And I saw that as being equities, companies able to grow their earnings over time, rather than investing into real estate for tax deductions.
Nice.
Now I'm just imagining you and Ed in the New South Wales dressing rooms arguing for stocks.
In one corner. Well, Peter, investing is a lifelong journey, something that we're always trying to improve at. There always is something that we can work on to get better. No one ever, I guess, reaches the mastering it, so to speak. So with that in mind, what are you personally working on right now on your journey?
So on my journey, very much the focus at the moment, we've just launched Viola Private Wealth, which we're incredibly excited about. Came about essentially a management buyout of the Pitcher Partners Sydney Wealth business. And what we've taken there is sort of all our sort of client base, but also the license, the infrastructure, the systems, all the key people. And we've sort of spun that out to establish, what we're positioning in the market very much as high net wealth investment advice at Viola Private Wealth. And seeking to move a little bit away from that, strong accounting brand that Pitcher Partners had. But very much the focus is that high net wealth investment advice space, being able to source compelling opportunities for wholesale clients and high net wealth clients. That's very much the space that we seek to play in.
It must be pretty crazy because on one sense it would have the feeling of a startup business, like you're going out it alone, you're building from the ground up. But on the other hand, like you're not building anything. You've got billions of dollars assets under advisement, and Charlie regularly tops the Barron's advisors of the year. What's that been like? The most established startup in Sydney?
I think we'll start using that actually.
Yeah.
Fundamentally, it's very much the same business that Charlie's built over a 20+ year period, and that's in communication with clients. That's sort of the key message is that really there's not much changing. Like it's a new sort of sticker on the door. You've got all the flashy new website and collateral and all that sort of stuff. But fundamentally, nothing really changes. We've still got the same support team that we've had that's been servicing clients over a long period of time, the same key people, but we're really seeking to grow the business now. So we want to be the home for the best advisors in the country and continue attracting that client base that we can really add value to.
Now, one thing we always find really interesting when we speak to Charlie is just the amount of opportunities that come across his desk from all these different asset class, all these different types of managers. And the real challenge for Charlie, and I imagine for yourself as well, is like developing enough of a understanding and an expertise in like different strategies and different asset classes to then make investment decisions on the back of it. So we'd love to understand your process in terms of how you upskill and how you learn. When a new opportunity comes across your desk, how do you get up to speed and feel like you understand it?
Yeah, great question. And that's sort of really the value add that we provide. So when we're talking about constructing portfolios for clients, it's, to start with very much from the ground up, we're looking to build a portfolio around, what it may be that they're seeking to achieve, their current circumstances, all of those types of things that, you sit down and get a good understanding of where clients are at and where they want to get to. But very much the value add that we can provide is that sort of deal flow, that wholesale and private market alternative asset deal flow. And the reason we seek to use that, we still use all the typical traditional assets, but we're able to better diversify portfolios and ensure that not all the capital is exposed to all the same risks. So we wanted to make sure that we're generating returns from varied sources, so that if we do see, weakness in equity markets, for example, we've got some things sitting in the portfolio that not only can generate a good return in their own right, but also don't move in the same manner. So when you hear people talk about, correlation, for example, that's what they're talking about, is they won't react in the same manner. So when equity markets are down, this thing might keep chugging along and doing what it's doing regardless of that. So in terms of the process sort of going through it, we are very fortunate that, essentially you've got people knocking on the door, my fund's the best fund. Yeah. Come and have a look at it. But very much in those more niche spaces, and there's plenty of them, and some really compelling ones as well. The ability to have an investment team with that sort of subject matter expertise that can put it through a rigorous process and do all the due diligence on it, but also our ability to have the portfolio manager come in and sit down and talk to it. So these are people with decades of experience. Working very closely in one specific niche of one specific investment market, and really understanding, what the drivers of the returns are, how they're mitigating risk, who the key people are, and what the risks are around that. But also understanding their process and their screens and all of those types of things.
And so how are you thinking about markets at the moment? Like, we've seen a pretty remarkable run over the past 12 months, and the US election has only sort of accelerated that in the shorter term. So when you're thinking about portfolio construction and how you're talking to clients, how are you balancing sort of the opportunity that is currently present versus, mitigating risk?
I suppose, we're looking at rewind 12 months. Over this period, it's been, equity markets up maybe 30% in the US, 20% in Australia, quite a remarkable year. I think every investor has, had one eye on the US election, and that's sort of, throughout that whole period probably dominated the landscape. And it's going to be interesting to see how that plays out, in the sense that, so Donald Trump, one of his sort of key pillars when he was, campaigning, one of the key platforms was cost of living and inflation, in addition to stopping world wars and all that sort of stuff that he's sort of said he was going to do. He's also going to kill inflation. Now, you put that in one sort of box, and then in the other box you've got, he's also, talking about tax cuts. He's talking about, trade wars and tariffs coming in. Now, these two things will be somewhat inflationary, you would expect. So, someone's importing something from China, for example, they slap a big tariff on it. The retailer's not just going to absorb that cost. They're going to pass that on, to the end consumer. Also, with tax cuts, you've got, more money sloshing around competing for the same assets. Again, inflationary. So when he's saying he's going to kill inflation, even his sort of rusted on supporter base won't take too kindly if he does that. So being able to separate what is rhetoric and what actually gets legislated, I think, will be the key thing. And it's really a case of wait and see as to what happens there. But in terms of opportunity and managing risk at the moment, we are very conscious that equity markets have run really hard. And a function of markets running really hard has been that, we're conscious that we want to be generating returns in other ways. So diversity is a big key thing that we seek to do. And in and around that sort of wholesale private market space, is finding really good opportunities that aren't exposed to the same risks as the equity market, and keeping a little bit of powder dry in case we do see some weakness is really the sort of prudent thing to do that we're looking to do at the moment. And that's the conversations that we're having with clients.
How much powder are you thinking about keeping dry as a percentage of clients' portfolios?
It's going to vary, and that has to be the answer, because each client's different, and we've got different liquidity requirements and stages of life. And if you're looking at someone who's still accumulating compared to someone who's already drawing down on their capital, then that dictates the answer somewhat. But ultimately, it's just not redeploying into equities, with some of the income that's being generated. So allowing a bit of that to pool, and then see what happens over if we do see legislation come in the US. But ultimately, if we're finding better opportunities elsewhere, then we'll continue sort of, deploying money into that. It's probably just a case of, keeping a bit of powder dry for equities.
So, Peter, we want to go back to the early days to understand, the motivations behind your interest in investing. Can you talk us through what was that intro to investing? What got you sort of passionate about, advice and financial literacy?
Yeah, so I had a bit of a sliding doors moment. It was a pretty profound moment in my life. I originally from Victoria, so don't hold that against me, and moved up for cricket. So I was contracted hadn't set the world on fire, was staring down the barrel of essentially getting spat out the other side and losing my employment. And I had a real sort of wake-up call. I didn't really have much to my name in terms of, any sort of savings to fall back on. Hadn't really figured out what I was doing, should cricket fall through. So it was at this sort of, juncture in my life where I'm like, I can't ever let myself be in this position again. So thankfully, it was a sliding doors moment. Things went the right way for me. I was, I managed to fashion a career out of, having no shots and nicking and nudging the ball around. But was very conscious from that point on. And that was, I suppose, my initiation to want to, educate myself as best I could around, investments and personal finance and all that sort of stuff. So like most sort of young people, I just dived straight into all the books and, you read all the foundational investment books, If yours was around at the time, I would have read it.
Of course, of course.
But then very much the ethos from that point forward was, don't spend all that you earn, borrow less than you can afford, and then, seek to put the difference into productive assets to, grow some wealth and have something to fall back on, if things don't go in the right direction career-wise. So over time then, I was fortunate that I was able to, nick them and nudge them for a much longer period. And then, things evolved from there. But that was the real sort of, starting moment for me in terms of really wanting to take control of my own destiny.
Yeah, nice.
Yeah. Now you're playing it down a bit. I think you had like a 13 or 14 year career for New South Wales, and you played 17 tests for Australia. So you built a pretty great career after that early slip up. But we're interested in your psychology, because throughout that whole time, you knew your career was coming to an end. Like, sports people have short shelf lives compared to most other careers. So how did you think about, managing your money, building wealth, knowing that, even, you by a cricketer standard had a long career, but knowing that it was pretty short in the context of your life?
Yeah, it is a very unique situation. Even for those that are, somewhat successful, you've really got a fairly short window in which, you can essentially earn a lot of money and build wealth or what have you. So very conscious, in and around that it could be a case of, you have one injury and all of a sudden, that's it, it's curtains. Or you have a bad half of a year and then you're out of contract and they decide to go, in another direction. Mm. So I think when you've always got that looming over you, I think the desire to really have a margin of safety and build a buffer in is sort of a key point there. But I think, understanding as well that when you come out the other side of that, and probably the best analogy I like to use is, it's like a bit of a J-curve. So think of like private equity, a J-curve, like the Nike swoosh. There is going to be an element there where there's no cheating the system. You essentially have to go into a phase where you're establishing yourself in a new career. Your earning capacity, will drop off. And much like a company sort of going through cash burn in order to grow, much faster and get out the other side, it's very much the case with, whatever your next career is. You need to make sure that you've, got the ability to supplement income if it's a case of you're not earning enough money, in your career to be able to support that. So probably got a unique perspective for a lot of other professional sports people that when they come out of the game, even if it's a case of they no longer need to work again, you really need to be able to generate a passive income and replace that earning capacity. And the best way to do that is, productive portfolio of assets that's able to generate that income.
And so were you educated at all? Well, was like the team collectively educated at all on how to prepare for that moment? Like, I imagine the transition could be quite daunting from not getting the final contract or calling it retirement through to then figuring out what is next and having a supplementary income. How did the Cricket Australia help with that at all, if at all?
Yeah, so there is. So the Players Association, the Australian Cricketers Association, are fantastic in that space. But, you can only lead the horse to water. There needs to be a certain buy-in from players as well in and around that. And, everybody's got a unique situation as well. But you've got to be very mindful that you do have a short shelf life and you need to ensure that you're sort of putting things in place for when that does come to an end.
Take us to those years and the investing education. Like, after that sliding doors moment, you got serious about learning. What were some of the great resources that you found at that time? What were the things that were really helpful? And were there any investing or money lessons that really stuck with you to today?
Yeah, so I, as I said, read all the books, and that was sort of my initial foray into investing. So there was, in and amongst a lot of them, there was one that really stood out, which was Peter Thornhill's Motivated Money. That was a really sort of interesting book. A lot of really good concepts there. Kept it all very simple as well, but that was sort of my initial foray into investing. Was very similar to that. Listed investment companies that invest in ASX shares that produce good strong dividend flows that mostly fully franked. And then so having that directly held portfolio, sort of companies that I did my own essentially DD on, but not having the conviction around them. And that was probably the key point is knowing what you own and why you own it, and the role it plays in your portfolio are all very sort of key pieces around why you're essentially holding on to these assets. And I didn't have that on many of them, and essentially got scared out of a couple of them that ended up going on and doing particularly well over time. So I think having that conviction was a sort of big lesson, but understanding exactly why it's sitting in a portfolio and the role it's playing.
So turning to today, clients come to you to build long-term wealth, and you have exposure to a number of different asset classes beyond just what is publicly listed. So how does that form your investment philosophy? What are the kind of key pillars and principles that you think about at Viola Private Wealth when it comes to an investing philosophy?
It's very much around diversity. It's very much around, not having all the capital exposed to the same risks, not all the eggs in the one basket, so to speak. But sourcing compelling private market opportunities that are able to, again, hopefully generate outsized returns over time, but not respond in the same way that equity markets do. You talk of a sort of personal investment philosophy. I very much eat my own cooking. So I'm very much aligned to what we do with clients. I seek to invest, exactly the same way. Being able to source those opportunities and being able to essentially not, have everything reliant on the performance of, one or two asset classes. It's incumbent upon that to be able to go out and find those. But ultimately, we're judged on the performance that we deliver over time and the outcomes we're able to generate for clients.
Peter, we've been closing these conversations with lessons for audience, and I think it would be interesting to also just get an understanding of, I guess, how you educate clients, and because I'm sure people come in with a whole bunch of wild preconceived notions about investing and how to build wealth. What are some of the biggest money challenges you see clients facing when they first walk in the door and meet you for the first time?
Yeah, probably typical of our client base is, they've either, sold a business or received a large inheritance. Essentially, people are wanting to make the best use of their, either excess cash or capital that they've received. We don't typically see people walking in struggling with the cost of living or inflation or anything like that. So it's really a case of, providing the strategic advice around getting the right money in the right buckets over time, ensuring it's structured tax effectively. So, looking at structures like, whether it's investing in your personal name through a family trust, using a beneficiary company. Superannuation's always such a key pillar there as well, but depending on stage of life, whether it makes sense, So these are all considerations in and around that. But very much they're walking in with, large amounts of money and going, I want to generate a really strong return. I want to be able to replace my salary or earnings, and be able to do that to fund, whatever retirement lifestyle or make work optional. And that's important to distinguish making work optional versus retirement. Some people want to continue working. Some people, wouldn't know what to do with themselves. It'd be like a dog chasing their tail if they woke up in the morning and had nothing to do. So it's about sort of making work optional, and then being able to buy bread and milk and jet skis or whatever floats your boat. That then makes life that worth living.
Nice.
Yeah.
Bread, milk and jet skis. So Peter, if you had to set up a retail investor's portfolio for the next 30 years, what are some of the principles you'd be thinking about? And you can be specific around assets as well if you would like. How would you go about that? What would be in it?
In the context of that we have to tailor this for each client and there's certain needs and circumstances and all of that.
General advice.
Yep, looking at your hat up the top there. From a principles perspective, again, diversity is sort of the key thing. But looking to invest it over a very long period of time, as always, the backbones of portfolios will be equities. So both Australian, international equities, Given where the Australian dollar's sort of sitting at the moment, about, say, 10% below its historical average, incorporate a bit of currency hedging there as well in the international allocation. I think a key point in and around that is that you're seeing more and more companies staying private for longer. So having some semi-liquid private equity exposure in there as well. Typically we're seeing these things able to generate a return comparable to equities or a little bit above equities with lower levels of volatility. So having that to complement the listed stuff, then probably having a fund that has, again, real assets with an operating overlay sitting in there, provides some exposure to, again, some property-based investments. Then probably an alternatives multi-strategy fund of funds that's got, some things that are a bit more unique and a bit uncorrelated. So, you're talking long-short equities or, distressed credit arbitrage and all these, some funds that are actually underlying funds that are closed to new money, but are also available only to institutional investors. So for the ability to access it through a retail vehicle, that's another sort of complementary growth holding. And then, something able to generate some income for the portfolio as well. So whether it's, some residential mortgage-backed securities or some, commercial real estate debt. Again, being very mindful that we want to have conservative LVRs, and have all those sort of covenants in place. We find that the risk compared to the return is a bit asymmetric there. So we're getting a pretty good return for the level of risk we're taking, considering that to get impairment within those strategies, you would have to see essentially residential property, suffer a monumental write-down, which, going back to your first question, where I was absolutely sitting on the fence, it's probably unlikely we're going to see that.
Yeah.
Well, if some of those strategies sound interesting, you can get in touch with Peter and he can talk you through them. If there was one lesson you could teach every new investor, what would it be?
We live in an age now where it's really instant gratification. You can go on a date like you're ordering a pizza. You can have something delivered to your house and turn up on your doorstep in a matter of hours. So very much in the context of instant gratification, patience. Get wealthy over a long period of time and don't get sucked into the new and bright and shiny thing that promises either by trading it or buying it you're going to amass this level of wealth in a very short period of time. Put your money to work in productive assets that have very real and demonstrated cash flows, because eventually what you're going to want to do is you're going to want to turn on that tap and use some of that cash to buy real things like jet skis, as you said. That's patience is the key thing.
Yeah. And then to close out, Peter, is there any conventional wisdom within the industry that you think is just wrong, or you often find yourself shaking your head at?
Probably the key one there would be just the perception of risk. I think often capital volatility gets equated to risk, where really the way to think about it is permanent impairment. So something going to zero. We don't really mind if something's bouncing around a little bit if we've got conviction that over time it's going to continue growing its earnings and paying a dividend and all these sort of things. That's not really risk in our view, because we are long-term investors. We're setting portfolios up for long periods of time, and we're not overly concerned if the capital bounces around a little bit, as long as we're getting to the destination that we're seeking to get to. So probably that would be the key one.
Yeah. Nice.
Yeah, I love that. Well, Peter, thank you so much for joining us today. All the best with your Sydney's most established startup, Viola Private Wealth. We're looking forward to following the journey and getting you on the show again.
Lovely.
Thanks, Peter.
Thanks, gents.
Before we go, we would like to thank Viola Private Wealth for their continued support of this series. Creating a lasting legacy requires thoughtful planning and expertise. Viola Private Wealth brings a blend of tailored strategies and decades of experience managing assets to help ensure your wealth benefits generations to come. For more information, head to violaprivatewealth.com.au.
Now stick around as this summer series continues next week. We're going to be speaking to Ben Griffiths, the is it too much to say legendary?
No.
He's certainly in Australian finance circles, one of the biggest names in Aussie small caps.
Yeah.
And then later in the week, we're going to be speaking to Ricky Bannon, a favourite of us here at Equity Mates. Not only, but it certainly helps, not only because she seems to pick multi-baggers every time she comes on the podcast. So make sure you're subscribed wherever you're listening or watching so you don't miss those episodes next week.